Hello, and thank you for joining us for today's webinar. We're going to discuss public comments submitted to the SEC regarding the proposed reforms to the offering and communications rules as they relate to BDCs and closed-end funds. My name is Owen Pinkerton. I'm a partner in the investment management group here at Thompson Hine. And joining me today is Chris Carlson, who is a counsel in Thompson Hine's investment management group. So today we're going to provide our views of what the final rules might look like based on the public comments that were submitted to the SEC. We're going to focus most of our time on the comments themselves and spend less time making predictions about what the final rules will look like. But I think you can learn a lot based on what's been submitted, and we'll share our thoughts as much as we can responsibly. Before we begin, though, we have some preliminary housekeeping notes. Today's program is being recorded and will be available on Thompson Hine's website. As we work our way through the materials, if you have any questions, please submit them using the question box on your side user panel, and we'll address them at the end of the program to the extent we can. A copy of the slides are also available to download and can be found in the user control panel. Chris and I will do our best to address all questions at the end, but we may not have time to get to all of them. If we're not able to address your question, we'll follow up with you directly following the presentation. With that being said, let's go ahead and get started. So I think it's useful to start off by saying that the webinar is designed to really not provide a summary of the proposed rules. We have a client alert on our website that talks about how the proposed rules relate to BDCs, and that's available if anybody wants to check on it. There are also about 20, 30 other ones that are out there, so there's no shortage of commentary on the rules themselves. Our focus today will be on the public comments that were submitted to the SEC. To the extent that certain proposals were supported by virtually everybody, we'll mention that, but we're going to spend most of our time talking about proposals where there's some level of disagreement, suggestions for improvement, or just completely alternative proposals that maybe weren't fully anticipated or are building on the framework of what was put out there. There were 16 comment letters that were submitted. There were comments from trade associations, law firms, sponsors, and third-party providers of services to BDCs and closed-end funds. There are a few themes that I think were evident, not just in the comment letters, but also in the proposed rules, the underlying legislation. The first was that the SEC combined the BDC Act and the Closed-End Fund Act, and it was part of the rulemaking. And I think that was designed to expedite the process and also try to get some sort of level of uniformity. But the piece of legislation was written very differently. The BDC Act was very prescriptive. It basically said, do this, 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 and this. And if you don't do it by a certain date, then it goes into effect automatically. The Closed-End Fund Act, on the other hand, was a lot more open-ended. It had a lot of the same goals in mind, but it didn't have the same level of detail, and it also did not become self-effectuating if rules weren't finalized by a certain time period. So I think that was a challenge for the SEC, and so I think that the intent was to try to provide as much parity as they could among the product structures, but in some cases, when you try to provide parity, parity can cut both ways. So it can be a benefit when it's reduced burdens, but at the same time, if you have one category of issuer that has more burdens, then sometimes you even up the scales by putting additional burdens on the other side. And so there's a little bit of both of those, and that certainly came through in the comments. The other thing that I thought was kind of interesting, and I'm approaching this from originally as a 3334 Act lawyer, is that the staff did not have the benefit of an integrated disclosure system. So for those of you who have only worked with 40 Act forms, 33 and 34 Act are, there's a regulation SK that includes all the item requirements, and then the forms refer back to them. So if you want to make a change to one of those requirements, you make the change to regulation SK, which really helps with uniformity among forms. With 40 Act, it's a lot different. So when you have Form N2, Form N1A, you might have the same sort of provisions, but unless you make changes to both of those forms, you can have areas where it's not not completely in line with one another. And I think that was a challenge also for the staff as they tried to grapple with, how are we going to, how are we going to make these two pieces of legislation workable, and also try to even the playing field a little bit. So as I mentioned, there were some areas of agreement across the board. I think from our perspective, we can confidently predict that these things will, in fact, be in effect and they'll be part of the final rules. Everyone that commented on it supported a short form registration statement. Again, everyone who commented was in favor of incorporation by reference. Allowing you to bring into your prospectus your periodic reports that are filed. Everybody was in favor of interval funds being able to pay as you go, but there are some other things we'll talk about later with respect to that. As far as prospectus delivery and being able to rely on delivery if your final prospectus is filed, that was something that everyone again was in favor of. And all the communications reforms, there wasn't very much comment about them, and to the extent that there was, it was mostly positive, with a little bit of tinkering here and there. But being able to rely on safe harbors found in Rule 168 with respect to regularly released business information, or tombstone ads in Rule 134, or the ability to use free writing prospectuses, those were all supported by everybody who commented on them. So that's a good framework. I think everyone's happy with all of that. So what we'll focus on now is areas where maybe there wasn't quite as much peace and harmony, so to speak. So with that, I'll turn it over to Chris, and you want to get us started?
Sure. Thank you, Owen. Just wanted to bring everyone's attention to the agenda on the slides. That'll be the structure for the rest of the program. So I'll provide background on the proposed rules. Then we'll cover submitted comments to the SEC, major areas of comment, predictions and complications, and Q&A. In terms of background on the proposed rules, the rules really came out of two congressional acts that were passed in 2018, but the groundwork for the offering reforms really started in 2005, when the SEC proposed securities offering reform rules that made extensive changes to many of the rules public companies use today to conduct securities offerings. The SEC's 2005 offering reform rules excluded investment companies, including closed-end funds, from the scope of the reforms. In 2018, Congress passed the Small Business Credit Availability Act and the Economic Growth, Regulatory Relief, and Consumer Protection Act. The former people typically refer to as the BDC Act, and the latter people refer to as the CEF Act. These laws directed the SEC to initiate rulemaking that would give BDCs and closed-end funds greater parity with public companies, or inclusion in the 2005 offering reform rules, from which they were previously excluded. The SEC's proposed securities offering reform rules pursuant to these acts were proposed in March of 2019. In general, those rules, among other things, allow certain BDCs and closed-end funds to use a short form registration statement to sell securities off the shelf, qualify as well-known seasoned issuers or WICSEs, satisfy final prospectus delivery requirements using the same method as operating companies, communicate with shareholders through the use of free writing prospectuses, and be able to rely on safe harbors relating to the use of regularly released factual and forward-looking information, including tombstone ads. The proposed rules would also permit interval funds to pay registration fees in the same manner as mutual funds and ETFs, and those funds generally pay after securities are sold on a net basis on what's known as a Form 24F2 filing. The rules would also impose new 8K reporting requirements on closed-end funds and expand the current 8K reporting requirements that are applicable to BDCs and would now be applicable to closed-end funds if the rules are adopted. The proposed rules would also require additional information in periodic shareholder reports, and that all BDCs tag their financial statements using inline XBRL. BDCs historically have not been subject to XBRL reporting requirements. And it's interesting to note that the XBRL reporting requirements were not addressed in the BDC Act. And finally, a note on terminology, because the release is heavy on terms. BDCs and closed-end funds are collectively referred to in the proposing release as affected funds. Seasoned funds are BDCs and closed-end funds that are current and timely on reporting requirements and have 75 million in public float. And WICSEs are BDCs and closed-end funds that satisfy the definition of seasoned fund that have 700 million in public float. Public float is generally defined as worldwide market value of securities held by non-affiliates, and market value is the value quoted on an exchange, not net asset value. And a fuller background is covered in recent Thompson Hine investment management updates. Before we get into major areas of comments and the submitted comments to the SEC, we have a spot on the agenda for questions, but if people have questions while we're speaking, please feel free to give those questions to us in real time, and we'll try to address those as we get them. The first major area of comments is on the part of the release that deals with the seasoned fund and WICSE determination. And the most controversial area was the SEC's decision to not really change the definition of public float so that funds that aren't listed on an exchange wouldn't be able to count their net asset value in the public float definition, therefore wouldn't be considered seasoned funds or WICSEs. Several commenters, including the ICI and BDC-focused trade associations, opposed this aspect of the proposal because it effectively eliminates interval funds and other non-traded closed-end funds and BDCs from taking advantage of rules that are limited to seasoned funds and WICSEs. These commenters argued in part that traded equity is not the only measure of how widely and closely a BDC or closed-end fund is followed by sophisticated players, and in many cases, particularly for non-traded products, the lack of a traded marketplace and the continuous nature of their offerings encourages enhanced due diligence by firms working on behalf of financial intermediaries, which may provide them with a level of external attention that may exceed the attention paid to similarly sized listed products. In addition, commenters pointed out that because BDCs and closed-end funds are held for investment by retail investors or institutions on behalf of retail investors, trading volume is not an appropriate metric for seasoned status, and trading volume is one of the aspects that the SEC was focused on, particularly in the 2005 offering reforms, as the reason for why they defined public float the way they did. The ICI argued that since BDCs and closed-end funds generally publicly disclose and value their assets, a major reason for the necessity of analyst coverage for operating companies is lacking. So the analogy drawn by the SEC in the proposing release to operating companies is inapposite in a significant respect. The ICI also pointed out that the Closed-End Fund Act explicitly directed the SEC to make the same offering rules available to interval funds, as is the case for public companies. And based on the SEC's own research, as noted in the proposing release, only one interval fund would benefit from the standard they proposed. Because of this, the commenters proposed alternative metrics, the first alternative being to just get rid of the public float requirement and allow seasoned funds and WICSEs to qualify if they're current and timely on their exchange reports, or they could use NAV as an alternative metric. One commenter also suggested a 5-year, 34-act reporting history and public disclosure of additional information through a website that would contain information traditionally provided to analysts in direct conversations with the issuer. Finally, this commenter also proposed, if the SEC still wants to go with a listed, a traded equity metric, that they should lower the threshold from 700 million to a lower one around 480 million, so that around 30% of listed closed-end funds and BDCs would qualify. The next major area of comment is the definition of ineligible issuer. So in the proposing release, an issuer is ineligible to rely on some of the reforms if they had an anti-fraud violation, among other things. And the SEC, in adding BDCs and closed-end funds, they also expanded this to if an investment advisor or sub-advisor aided and abetted the issuer's violation of an anti-fraud violation. Two BDC-focused trade associations recommended clarifications that this modification to the definition of ineligible issuer should not pick up violations of anti-fraud provisions by the advisor or sub-advisor that are triggered because of compliance violations, as the Advisors Act compliance rules is promulgated under the anti-fraud provision of that act, and therefore technical violations of a compliance program could result in an enforcement action and therefore result in the BDC or closed-end fund that's advised by the advisor or sub-advisor being an ineligible issuer. And with that, I'll turn it over to Owen.
Thanks, Chris. So the next item, and this was a big one, at least for closed-end funds especially, was making Form 8K be required for all closed-end funds that report under 13A or 15B of the Exchange Act. So the BDCs have had to report because they're 34 Act. Because they're subject to the 34 Act reporting requirements, BDCs have to file 8Ks in addition to 10Qs, 10Ks. And so historically, there have been a number of item requirements under Form 8K that just don't really fit very well for BDCs. But over time, they've kind of figured out what works, what doesn't work. The SEC really hasn't provided any additional guidance. They also haven't provided negative guidance, I guess you could say. So the proposed rules would have closed-end funds be subject to the Form 8K as well, in addition to two new requirements that I'll discuss a little bit later. The main opposition to this, so this was something that was not part of either. This was not part of the Closed-End Fund Act. So the main opposition came, from ICI and some others that pointed first to the intent of the Closed-End Fund Act, which was to reduce unnecessary regulatory burdens and provide cost savings to shareholders, enhance the ability of closed-end funds to serve as financing sources for portfolio companies, and to stem the decline in closed-end fund offerings. And their initial reaction was, basically these rules are supposed to result in less burden and it's supposed to promote new offerings. If you require that we file additional forms, that hardly seems to fit. And this is one of those areas where I think the SEC was trying to instill a little bit of parity, but in doing so, put additional burden on closed-end funds. Closed-end funds right now, they're very, very limited instances in which they have to file 8Ks. And commenters also noticed that in recent years, when other changes to Form 8K had been made, there was an opportunity to bring in closed-end funds, and the SEC never chose to do that. So again, their view is this doesn't go with the intent of the act, and also if it's not broken, why fix it? Right now, the current practice for closed-end funds is really it's a little bit disjointed. I think this might be where the SEC is coming from. Closed-end funds might file a supplement. If they have a continuous offering going on, they'll report material items with a supplement. If they're listed on an exchange, they might file a press release, depending on what the listing requirements are. Or either way, they might disclose in their shareholders report that they send to the shareholders, or post it on their website. So I think from the SEC's viewpoint, they could easily counter that by saying that's all great, but it would be really, really nice if there was one place where you could look for some of this information. Incidentally, and I can't let this go, but I have to mention this. ICI also noted in their comment letter that in their view, closed-end funds have greater regulatory filing burdens than operating companies. So let that sink in for a second. I don't really agree with that, but that's that was part of the argument as well. Historically, I mentioned that BDCs don't have had to live under this regime. Historically, there are 7 of the 23 item requirements that BDCs have never filed under, and there's very low volume in many others. So there's probably about 6 or 8 that are very common, and that's what the closed-end funds would have to comply with if these rules are adopted. The ICI had a backup recommendation, which was if you are going to mandate Form 8K filings, then it would be great if you could tailor those for closed-end funds, or at least specify which ones definitely apply and which ones do not apply. There's concern on their part, and I think this is founded, although you can look at what BDCs have done historically. Their concern is that if there are foot faults, there are real ramifications, and the ramification is that you could lose your ability to file a short form registration statement or qualify as a WICSI. And if it's an inadvertent compliance issue that it's because you're not familiar or not used to making 8K filings and have questions about what's material, whether it fits in certain boxes, that's the last thing you want to have happen. And even if there is a waiver processes take time. So the main thrust is that the commenters do not want 8Ks to be requirements for closed-end funds, but if they do, there should be more guidance surrounding it. The 2 new items that were proposed by the SEC, the first one, which is making any material change to investment objectives or policies. This would apply to any situation where a matter is not brought to shareholders for approval, and they would have to include the date of the change, the description of the change, and they'd have the option of including any risk factors or other disclosure to include with the 8K. There was one commenter who had some suggestions for how to improve this, or actually more accurately, didn't think that this was appropriate because it's a little bit too generic, and it's not always clear when there's a change in the investment policies or strategies. And sometimes it's obvious, and in those situations there would absolutely be reported in one form or another. Situations where it's less obvious, you can do a lot of second guessing and look back and say, this is when the change was made, but it's not always that clear. So we're not really sure where that one's going to end up. Again, there was only one commenter who even addressed this item, so it's possible that because of that it might go through anyway, but there might be additional guidance surrounding it. The second one is disclosing any material write-downs in assets, and the analogy was made to a current 8K item 206, which talks about if there's material impairment. Since funds use fair value accounting, impairments is not relevant, but a write-down of fair value would be. So this requirement would cover any investment, even ones that have public pricing information, but it would have to constitute at least 10% of your total assets. And so the idea isn't to constantly require 8Ks for immaterial assets that aren't really having that aren't going to have an impact on NAV. So it has to be more than 10% of the total assets. The requirement is that you'd have to include the date that the company concluded that there was a material write-down, an estimate of what the range of amounts of the write-down might be, and if you're unable to estimate the range of write-downs, then you have within 4 business days of making that determination, you have to amend the 8K to provide that. The staff recognized that valuations, real NAV determinations don't necessarily take place on a daily basis. But they also understood that most closed-end funds do have daily pricing, and if they have daily pricing, then there's some level of determination of NAV. But so for BDCs, the only ones who had comments on this were from the BDC trade groups, and their view was essentially that For BDCs, very few of them have anything that resembles daily pricing. To the extent that there are intra-quarter change valuations, it's done in connection with an offering. Basically, you want to make sure that you're not selling below NAV. And in those cases, it's generally not the board that's coming up with an NAV. It's a determination. You look at the prior quarter NAV, and then you carry it forward. You look for any sort of changes in value that are known, and then you make adjustments. So for BDCs, the time period when you would conclude that there is a material write-down would coincide with when you're going to be disclosing that in your 10K and 10Q anyway. So it seems to be a little bit redundant. And from a timing perspective, if it falls within, if you file your 10Q within 4 business days of when the board meeting is held to adopt an NAV, then you can disclose it under the other information tab in your 10Q or 10K anyway. So from their perspective, they didn't think that it was really necessary to do that because it's being done already. But they were willing to consider situations where maybe there's additional disclosure that can be attached to these, and there seemed to be some willingness to do that. But a separate AK item, there was some opposition. I think the tricky thing here is that if I can't imagine the staff coming back and saying, okay, that makes sense for BDCs, but you have to do it for closed-end funds. So it's either gonna be adopted as is, or it's gonna be changed pretty dramatically. And I'm not sure which one it's gonna be, but they're not gonna have one set of rules for one and one set of rules for the other. So turn over to Chris.
Okay, the next topic of discussion among the commenters was on the requirement to disclose material unresolved SEC comments in annual reports. 2 commenters, including the ICI, opposed this requirement. And they focused on materiality and what it means for a comment to be unresolved. So the release says it needs to be disclosed if it's material in the view of the issuer, and it's not always clear what material means. And generally, SEC comments, they can come in flavors that are mandatory and not mandatory, and they can be suggestions for the issuer to consider certain things. So it's not clear what's material in that context, and the items that the SEC staff focuses on may be too technical for retail investors to appreciate. Also, whether a comment is unresolved is a matter of debate. The staff doesn't tell you if a comment is resolved or not. Obviously, if you comply with a disclosure change, that could be resolved, but there are other types of comments that they can give if they ask you to consider certain things and you argue back to them about why you shouldn't. It's not clear whether or not that will be resolved because the staff generally would come back to you and tell you that they don't have any more comments. And another point that was made was that requiring this disclosure as part of a form requirement for annual reports seems to elevate SEC staff comments above the status which they are, which they are not statements of the SEC. They don't have the force or effect of law. You go.
Is that this is a 10K requirement for operating companies and BDCs, and generally it takes a lot to for an issuer to include disclosure here, and there's usually a lot of, I think the staff, at least in Corp Fin, is very attentive to trying to help an issuer not have to disclose something here. So it's there's some history here, but I've also seen situations in investment management where if they're doing a 10K review for a BDC, for example, that they issue comments at the end of March. And if you issue comments at the end of March, then it's awfully hard to know exactly whether or not you need to disclose something there. So I think there is some history with BDCs, but it's also, this would put pressure, or at least I think it would be a two-way street. The staff would also have to be mindful of the fact that if this disclosure requirement is there, that you have to be careful when you issue comments, because if you put the issuer in a situation where you have to make a determination after looking at comments for 2 days, that's not really fair. So it does cut both ways. Who knows if it sticks around, but if it does, I think there will be pressure on both sides.
Thanks, Owen. The next topic of discussion amongst the commenters was a requirement for management discussion of fund performance disclosure in annual reports for closed-end funds, similar to what is already required for mutual funds and ETFs. And although commenters generally supported this requirement, commenters, including one major sponsor of closed-end funds, suggested that the SEC make the new MDFP section less prescriptive in terms of what needs to be included, because closed-end funds have significant differences from mutual funds and ETFs. One is that they typically incur leverage and have leverage as part of their strategy, and two is that they also trade at premiums and discounts. So those are things that may have more of a material impact on fund performance than items that would be required under the proposal, which would be the effect of particular securities that were traded or the performance of the fund against the benchmark. And with that, I'll turn it over to Owen for XBRL.
Yeah, so I'm not going to get all technical here because I'm not able to, but XBRL, back in when XBRL first came about and became a requirement for operating companies, they issued, the proposed rules went out. There's one commenter who came back and said that the taxonomy was not sufficiently developed for BDCs, and the result was that BDCs were excluded from having to do any XBRL reporting. So there's a checkbox on the Form 10Q and 10K that indicates whether or not you've made your XBRL filings, and BDCs leave that blank because they can't say yes or no. So there was always the expectation that at some point in time the SEC would come back and put XBRL requirements on BDCs. It was just never really clear when. And as Chris stated earlier, this was not part of the BDC bill, but I think this is the give and take that the staff was trying to, did with the proposed rules. In this case, they were imposing the XBRL requirements on BDCs, just the same as other operating companies. For the most part, I think most of the financial statement line items are not all that different than a number of different issuers. So that part should probably be pretty smooth. I think there'll be a lot of the work will be with the scheduled investments, and if you have a really large portfolio, that can be a lot of tagging and a lot of expense. But there are commodity ETFs that are doing that right now. So there is all printers and other third parties that are used to that have worked with XBRL are used to doing that or have done that before. So the commenters who came back and had the ones who had comments on it were mostly XBRL firms, and they pointed out that the cost of the initial adoption or the initial application of XBRL is not what it was when XBRL was first introduced. It's a lot cheaper. And then once you've done that once, it's a lot easier as you go forward. So the only comments that came in on XBRL were in favor of imposing XBRL. In fact, the XBRL groups wanted to take it to the next level and also require that some of the XML schemas that they have for like the NSEN and the NPort, and even like they mentioned for Reg A filers, they wanted all that to to the extent possible make it all XBRL, which of course makes sense because that's what they do. But they were the only ones who commented on it. Nobody came out opposed to it, so it's likely that this will go into effect. There's also some minor changes to the forms, Form N2 and 24F2 that where XBRL will be put in place as well, or could be put in place. I guess that was one of the comments. But some of the other cover page information will be required to be inline XBRL as well. So with that, that's kind of a nice segue for Rule 24F2. And again, the proposal there was no opposition. Everybody was in favor of allowing interval funds to pay the registration fees on a net basis, on an annual basis, and at a net basis annually. Basically, pay as you go. And the only things that came in it was kind of interesting. I wasn't expecting this, but it does make a lot of sense, I think, was that there are some other entities that were basically said, wait a second, if you're going to do that for interval funds, you should do it for us too. And the major ones were commodity ETFs. And so what they are is essentially they're not regulated under the 40 Act, they're regulated under the 34 Act, but they're entities that buy futures contracts, but they do it with the same sort of creation and redemption baskets that ETFs do. And so they run into the same issue that ETFs that are regulated under the 40 Act run into, namely that you never want to be in a position where you run out of shares. And you need to be able to, always need to be able to have shares to issue either in a creation or a redemption. Otherwise, you lose the, you're not going to be able to track the index. You're not going to be able to track whatever you're supposed to be tracking. So, and for them, for the commodity ETFs, it's also extremely expensive to have to register fees up front because you never know how many you're going to need, and so they over-register. And when they have to do annual updates in order to go effective, there's always some question about whether or not they should be filing a new registration statement in order to increase the shares that they have. So I thought that was a really interesting suggestion. It came in from a couple of different commenters, all in that space, and they were, I think, wise to pick up on this and see that this does make sense for them as well. One other commenter encouraged the SEC to allow new interval funds to be able to pay fees on a pay-as-you-go basis immediately after the final rules are put into place. The proposed rules would have a one-year phase-in period, and that's largely to, I think, accommodate the fact that current interval funds would be switching from one structure to another. And so the one-year phase-in period would really allow that to go smoothly. But for new ones, they raised the question of, well, why not have that apply immediately, which is certainly good. There's also one commenter that said, well, if we're going to do this for interval funds, why not do it for tender offer funds as well, closed-end funds that offer liquidity through periodic tender offers. I suppose that could happen as well, but I guess I'd be a little bit surprised just because interval funds are treated differently in a lot of different respects, not just at the SEC, but also at FINRA. So interval funds are deemed to be more closely related to mutual funds because of the mandate of liquidity. So I guess I'd be surprised in that, but you never know.
Yeah, that was interesting on the 24F2 point. These commenters that are 33X ETFs wouldn't necessarily be affected by the reforms because they don't register in the 40 Act, but the SEC kind of invited this sort of comment in because they went beyond the directive of the BDC and CEFX to initiate rule parity, and these commenters are essentially saying, hey, we're more like closed-end funds too, so we should be able to take advantage of those rules. And since they also trade in volatile markets, having them to pay for shares before they're sold creates major practical difficulties for them, and it could be harmful to shareholders. The next area of comment was on the subject of forward-looking statements. So both the 33 and 34 Acts include safe harbors for forward-looking statements that are made by issuers. And investment companies aren't included in those safe harbors by the statute, but the SEC has the ability to include them by rule. And because the offering reforms give BDCs and closed-end funds the ability to make more forward-looking statements in the context of ongoing offerings, and they're encouraged to do so. This commenter suggests that the SEC should also use its rulemaking authority to give these investment companies the benefit of the safe harbor. And this, along with the 24F2 comments, may introduce some delay into the rule because right now the proposing release really has mostly the Division of Investment Management staff on it. And so in order for the SEC to act in those other areas of law, they may need to bring people in from the Division of Corporation Finance and the Division of Trading and Markets in order to appropriately consider the comments. And I think the next topic is on 486.
Yeah, so we're getting closer to the bottom. So these are smaller issues, but for the entities involved, certainly important still. The next one was, there have been a line of no action letters that have been issued since 2010 to closed-end funds that are not interval funds that allows them to update their registration statements pursuant to Rule 486B. And 486B is what interval funds use to update their registration statements. And it permits you to, assuming you meet certain requirements, that you can decide when you want to go effective, and that can be immediate if you want to do it that way. A couple of, at least I think it was two commenters pointed out, and I thought this was a good catch because it's the sort of thing that I don't know that the SEC was thinking of, but they pointed out that the ability for those closed-end funds to get immediate effectiveness on their annual updates would essentially be taken away if the new rules went into place, because the proposed rules would allow WICSs to file a registration statement, an automatic shelf registration statement, which would allow you to forward incorporate by reference. But if you don't qualify as a WICSI, then even if you're a seasoned fund, you would be able to file a short form registration statement, but it doesn't have the same abilities that you would have under the existing line of letters. So the commenter suggested that your three options: you can either keep the no action letters in place, or in other words, let them remain operable. You could codify the positions that are taken in the no action letters, or basically open up Rule 486 to all closed-end funds that are tender offer funds that meet certain requirements. And they pointed out that 485 is that for mutual funds is very broad, and you could do the same thing under 486. Incidentally, the ones who made the suggestion, and I don't think they did not suggest that BDCs be included. They were silent on that point. But since BDCs are regulated under the 40 Act and not registered under the 40 Act, it would probably require a little bit more work in order to have them be able to rely on that. So I doubt very much that the SEC would ever add something that's not included in the comments. So I don't think there's any hope of that. And finally, at the end, there are a couple of catch-alls that were these were mostly brought up by law firms that are reading the rules very, very closely. And one was that there's the Form N2 would be modified to include a checkbox if you're registering only DRIP securities, and they wanted to make sure that if they do that, that's fine, because there are very, very limited instances in which you would register your DRIP securities. But if you do, they want to make sure that the SEC at least mentions in the final rules that the position under the Guide 5 to Form N2 is that if you meet certain requirements and you're issuing DRIP shares, it's not a sale of securities, and they don't need to be registered. I hope that doesn't open up a Pandora's box. I don't think it will, but the corporation finance takes the exact opposite view. So that's always one of those areas where it actually would be great if it was in a final rule release as opposed to just this guide, because that guide is hard to find, and it's not. You can find Form N2, and they don't always have the guides with them. So to the extent that they could codify that in a more official place, that would be fantastic. There was also an issue that was raised about Rule 23C2, and which requires the filing of you have to, within 30 days, you have to give 30-day notice to of an intent to redeem preferred securities. And for a WIXI or the ability, it really would impede your ability to sell securities off of the shelf, or even a seasoned fund for that matter. So they recommended that if you're going to have a notice requirement at all, 30 days is too long, maybe 10 days, or just remove it entirely. And finally, there were some suggestions on the undertakings that were, that are included in Form N2. One of them was to conform to changes that were just made in the FAST Act to other forms under the 33 and 34, under the 33 Act, I guess. And there's some others there are a couple of others that just don't seem to make sense if these rules were to go into place. So with that, I think that's the general thrust of the comments that came through. I said that we would give some discussion about what the predictions what kind of predictions we have, and complications that are out there. The first, we've mentioned this in a couple of different ways, but this I think will be a really interesting question. Is some of the proposals that came through from the commenters are corp fin issues. They're not investment management issues. If you look back on the proposed rules, there are no individuals are listed there from Division of Corporation Finance. So for the commodity ETFs that are looking for additional, that want to be treated like interval funds, it makes a lot of sense, but it would require that somehow Division of Corporation Finance be brought into the mix. Similarly, the forward-looking statements that Chris talked about, those are 33 Act rules, and I don't think that Division of Investment Management will recommend changes to those without really bringing in Division of Corporation Finance. So I think that'll be interesting. That it doesn't mean it won't happen, but if it does happen, that it takes more time, and it's very possible that those sort of things could delay final rules. I mean, there are all sorts of reasons why final rules could be delayed, but that's certainly one of them.
So the other item where we're prognosticating here is the timing of the implementation of the rules that are applicable to BDCs and those that are applicable to closed-end funds. So this rulemaking, as mentioned previously, was initiated by two separate acts of Congress that also have two separate deadlines, and the deadline for the BDC rules has already passed. And so since Congress doesn't trust the SEC to meet a deadline, it basically said in the law itself that if rules are not adopted by March 2019, whatever rules that are proposed are considered to have the force and effect of law. So technically those rules are already effective. But there's a major question of what happens if a BDC wants to rely on the new flexibility that's given by the proposing release if the SEC, when adopting final rules, makes material changes. So that's a question and a risk that BDC issuers face. With the Closed-End Fund Act, the deadline for that has not passed. That is not until May of 2020. And if the SEC doesn't get its act together before then, any registered closed-end fund that is listed on an exchange or is an interval fund is determined to be an eligible issuer. In other words, they're able to rely on the securities offering reform rules from which they were previously excluded in 2005. So it would be interesting to see, in all likelihood, if there's still a year for the SEC to adopt these rules, it'll probably make that deadline, so that provision probably won't have any practical significance. But the BDC provision does have practical significance, and it may affect how some issuers wish to conduct their securities offerings or their filings going forward.
Thanks, Chris. So with that, we'll open it up. We've got about 10 minutes for questions. We've got a couple of them here. The first one, I apologize, it says that they don't see the PDF of the deck in the handout tab. Hopefully that was addressed. If it wasn't addressed, what we can do is we can make sure that we send this to everybody. I apologize for not seeing that earlier, but we will. If the PDF was not showing up, we will we'll send it around afterwards. It didn't go into a great deal of detail, but we were happy to send that out.
I think one of the comments maybe you addressed it, Owen, is which comments were surprising.
Oh yeah, and you might have different views than me, but I think I was surprised with the commodity ETFs. I think bringing, I think that makes a lot of sense, but it's always tricky when you comment on, if you're not a 40 Act product, you can't comment on a 40 Act release. It's you never know how those can be treated, but I thought their comments were well drafted, so that'll be interesting to see. I also was a little bit surprised that there wasn't a pushback by any of the BDC trade groups or BDC issuers when it comes to XBRL. Maybe it's not as big of a deal as I thought it would be. I expected there'd be more pushback on that. Did you have different views? Or?
No, I agree. I was surprised by the commodity ETF sponsors commenting on this release, but I think it makes sense, and given that the letters were thoughtfully presented, I think the SEC has to address those in the final release.
Next question that came through is, based on the level of comments received, can you provide an estimate of when final rules may be issued? Yeah, Chris will do that.
I think in all likelihood, we're already past the deadline for the BDC rules. I think it'll probably be before May of 2020, and with major rules, sometimes the SEC likes to get it done before Christmas. So my prediction is before December or right on Christmas Eve.
I think you're a little bit more optimistic than I am. I think that would be great. I think it might take longer than that, just because I feel like the staff is still trying to balance the different products, and because there was some pushback on certain issues, but not others. I don't know. I guess I'm not that optimistic, but that would be great. I think I would say March of next year. That's my prediction. We have one more question here. If anybody else has any other questions, feel free to throw them onto the queue, and we will be happy to address them. There's one more we have here. The concept of parity was raised numerous times in the legislation and proposed rules. Do you think the proposed rules achieve the goal of promoting parity across product structures?
I mean, I think they did to the extent possible. I mean, obviously BDCs and closed-end funds, although sometimes their investments will overlap. You have a lot of BDCs that are focused on credit investments, and closed-end funds are also focused on that. The form types that they use for shareholder reports are different, and their prospectuses look a lot different. But I think in terms of adding more flexibility to the various rules, in terms of free writing prospectuses and the like, I think there is a lot of parity there, and possibly more than closed-end funds may use, but BDC issuers may seek to use in the future.
Yeah, I think that's well said. It's there are real limitations here as to the ability to provide parity. There was a DC bar event that I went to on these rules, and someone from the SEC made the comment that when they were sitting down working on how to address these various issues, and somebody raised the question, why is it that BDCs have to register under the 34 Act? Because this is not just listed BDCs. You can be a private BDC where you're just issuing shares to the public privately, pursuant to Reg D, but you still have to register under the 34 Act. And there just wasn't enough institutional memory there that they didn't have a great answer to it. And it seems like it was one of those things that got thrown into the legislation, but maybe there was a great reason for it, but they were struggling with that. And that has an impact on a lot of these different things when it comes to parity, because if If you're a private fund, you don't have to, you don't have any periodic reporting requirements for the most part. I mean, unless you have enough shareholders. If you're a private BDC, you're subject to everything, and XBRL being one of them if this goes through. So I think there's some issues like that in the background, and when it comes to parity, I also look at the way other regulators deal with these products. And if you go to FINRA and you're doing a public offering, an interval fund is subject to one set of rules, which doesn't require you to file at all. If you're a closed-end fund that does tender offers, then you're a corporate issuer and you're subject to those rules. If you're a BDC and you're doing a public offering, you're considered you're under 2310. You're under a completely different set of rules. And so you could have the same or similar types of assets in those three structures and be subject to three entirely different rules under FINRA. And it's not all that different at the state level. So if you're a BDC, it's not a covered security because they're not registered under the 40 Act. So then you have to qualify the offering in each state. Whereas if you're a closed-end fund, it's a covered security and you don't. So we will never have parity. But I thought that I was glad to see that they were mindful of it, and I thought I think it's an appropriate thing to try to do, and I thought they did a pretty good job of doing what they could based on the circumstances. Let's see. Yeah, so we don't have any more comments in the queue. We have a couple of minutes if somebody has a last second comment. Otherwise, appreciate everybody joining today's webinar. And we hope it's been useful. As previously mentioned, an archived copy of today's webinar will be available on our website at www.thompsonhine.com. Please reach out to either one of us directly if you have any additional questions. And as noted before, we will send out the slides this afternoon following the end of the webinar. I don't see any additional questions, so thank you very much, and everybody have a nice rest of your afternoon. Thanks for joining.